Whether you're married, have kids, or are caring for elderly family members, your IRS tax filing status can greatly influence the tax that you have due each year. From credits and deductions to choosing the right filing status, there are many factors to consider. Today, we'll go over the various family situations that affect taxes and give you some insight on how to make the most of the tax benefits that might apply to you. All right, so Spencer, today, as we talk about this and as we record this, the Tax Cuts and Jobs Act is still enabled and enacted. Now, tax law changes sometimes on a year-to-year basis. So we would say, as you are hearing this, as we're talking about these credits, deductions, filing statuses, all these things, always take any of this to your CPA and ask them if this makes sense for your specific situation. Now, as we dive in, there are some basics that we need to understand about filing statuses. We've got several different statuses that we can file as single, married filing jointly, married filing separately, head of household. Can you walk us through just some of the basics of each of those and what are some of the differences that they have?
And disclaimer here, this is not encouraging you to have children or to get married just to avoid some tax from the IRS. You know, a recent study came out that suggested that each child costs about $1,500 on a month-to-month basis on average. So $18K a year per kid. Yeah. Very expensive. And, getting married, obviously a lot more important things than how much do you pay Uncle Sam together. But as we give that caveat coming in, filing as single is the most straightforward. You have tax brackets, marginal rates that kind of stack one upon the other. You have a standard deduction, of course, there if you don't get above a certain threshold in itemizing. When we look at married filing joint, we've got oftentimes double the size of the brackets, and then we've got double more or less the standard deduction. When we look at married filing separate, that is the most punitive of these particular tax brackets or statuses, I guess, outside of being a trust. So don't declare yourself a trust would be another thing. But married filing separate, you don't get a lot of the benefits. The only reason that you might do married filing separate is if you have a spouse that is from another nationality, or if you're concerned that maybe your spouse is cheating the IRS and you want to be straight and narrow, in terms of you're dealing with the IRS. There are certain situations that married filing separate can make sense, but oftentimes it's going to be more punitive. So it's not a filing status that we see a whole lot. And then finally, of course, head of household would mean that you have one or more dependents under you, but you would otherwise be a single filer. Right. And there are some benefits there, both in terms of the standard deduction and then the tax brackets, the size of those tax brackets versus being a single filer. So that's kind of the big picture of those different types of filing situations.
Right. And there's one more caveat. There is technically a qualifying widow status that only applies for the first year wherein your spouse passes away. Right. So you still receive a married filing jointly status in that first year that you are a widow. Let's say your spouse passes away in 2024, that applies for 2024. But then in 2025, you go back to being a single filer. And the other thing with married filing separately, especially for our clients, is that if you choose to do this and you're receiving Medicare, your IRMA surcharge brackets are compressed really tremendously. And so we would say if you are receiving Medicare and you are married, really consider, is this going to be the best option for you? All right, so let's talk about children. What are some of the tax benefits of raising a family?
Well, thank goodness the government helps out a little bit here in providing some credits because, like we talked about at the top of the show, it's expensive. A few years ago, we got our second refrigerator because we were getting eaten out of house and home. And even one trip to Costco a week wasn't going to be enough if we didn't have that second fridge. So thank goodness Uncle Sam is right there for us. It provides, the child tax credit provides up to $2,000 per child under age 17, with up to $1,400 of that being refundable. So if you didn't have tax due otherwise, and let's just say you have 4 kids, then the government will actually pay you some money to help out in raising those 4 kids. When we think about another one would be the dependent care credit. Now, this is one that sounds really good, but there's so many different limitations within it that it doesn't end up oftentimes working out to be quite as much of a credit, but it can be worth up to 35% of qualifying expenses depending on your income. Now, oftentimes your income will exclude you from getting that full benefit, but let's just say, that you had $10,000, of qualifying expenses. You could have a tax credit that helps you to deal with that dependent that cost of taking care of your dependents, basically there. Of course, another piece of this is that if you have children, hopefully you're looking to educate those children. So you want to talk a little bit about the help that Uncle Sam gives in educating our kids.
Yeah, there are 2 college credits that you can get, the American Opportunity Credit or the Lifetime Learning Credit. So the American Opportunity Credit is for up to $2,500 per student for the first 4 years of college. So this is just undergraduate expenses. The Lifetime Learning Credit is up to $2,000 per family for qualified education expenses. And this doesn't have to be limited to undergrad. It could be if you have a professional licensure that you're wanting to go after. You may be able to qualify for that if it's a qualified education expense. And so these credits both help offset education costs, but they also have specific eligibility criteria. So if you have kids in college, or if you are going for a professional licensure or some sort of thing like that, you just want to make sure that you are making sure that you're within those eligibility credits or eligibility criteria before you file for those credits. So Spencer, let's talk a little bit more about elder dependent care. What are some of those things that we need to focus on for elder dependent care and receiving some of the credit that you can for those things?
Well, and this is one of those areas that is oftentimes surprising for people because they think, okay, well, I was taking care of kids and raising them, and I got child tax credits. Well, if you have a mother, father, aunt, uncle that moves in with you, you're taking care of them, and you are providing for at least half of the expenses that they have, then they're technically a dependent of yours. So you do have the capacity for a dependent care credit that would be up to $500 per qualifying dependent, which can, again, help provide some relief. Now, just like we would see really on the child side of things, they get layered in with your overall tax return. So if you have, heaven forbid, a child that has significant medical expenses, then their medical expenses can be layered on top of yours, and you may be able to deduct a portion of that if it's above and beyond 7.5% of your adjusted gross income. It's the same thing in terms of medical expense deduction if you have elderly dependents. And that's one that can really rack up. So if you're taking care of mom or dad and you're paying for more than half of those expenses that they have when they're under your roof, then you can start to layer on those medical expenses.
Right. And so some of these other tax considerations for families that we want to touch on, we've got the medical, we've got caring for parents and maybe even grandparents at times.
Sure.
There are other tax considerations such as the adoption credit. So we both have adopted children. Adopting a child is not cheap.
Right.
And so the federal government decides that, hey, maybe we will give you a little bit of help. And some of this credit is also partially refundable. So what are some other credits that maybe have opportunity set there? Anything more that we want to touch on with that adoption credit?
Well, the adoption credit, of course, it's north of $10,000. It's a credit, so it's not a deduction. We've talked about this in prior episodes, but a deduction is one that can lower your income, basically. So your income is less, so the amount, the percentage that you've got to pay based on that income is also less. The credit is a dollar for dollar reduction of whatever that tax bill would be. So it can be a really nice incentive there. Now, they're never going to pay you, and you're not going to get to a point where you actually come out ahead in doing an adoption or something like that. But there is a level of say reimbursement there that can be helpful, and that's usually not going to come to anything close to the actual expense. And believe it or not, adopted kids, it's about $1,500 a month for them too, just like any other child. So if you're keeping score at home, that $18,000 a year is adding up, as well there. But it can help in the initial expenses that you might incur in the adoption arena.
Right. So one of the other ones we want to touch on is health insurance and child healthcare costs.
Right.
And so if you are filing as a head of household, and let's say you are a single parent and you have 3 kids under the roof, then you can file for marketplace health insurance. And you have to make sure that you are the one that's caring for the kids more than 50% of the time to be able to claim them under your household. But then you may be eligible for a premium tax credit for your marketplace insurance. These are all subject to income phase outs, but that is a potential benefit that you might have where you might not have if you were just an individual filer.
So it can actually have an impact. If the more kids that you have, it can have an impact in reducing the net cost of your health insurance, again, primarily by getting more of a subsidy there if you're in one of the marketplace plans.
Right. And again, we wouldn't suggest, again, adopting children for tax benefits, getting married for tax benefits, having more children so that your health insurance costs less.
Right.
These are not reasons to go do these things. These are just supplemental government benefits that you get from these other things, but not reasons to pursue them. Right. So always think about that. Have that in mind when you're thinking, man, how can I reduce my marketplace cost for my health insurance? I'll go adopt a child.
Yeah.
That's not going to reduce the cost by and large across the entirety of what you're going to be paying for that child.
Right, right.
Adopt children because it's a beautiful thing to adopt children, not because you get tax benefit. All right, so Spencer, we've talked about what are the different reasons that you should choose or should not choose different filing statuses. Anything that we really need to consider before we close out today?
Just know that in each one of these different areas, the government does afford some different benefits. We just don't want you to miss those benefits. There are credits, there are deductions, there are ways that you can kind of think about this. And sometimes they're even surprising, whether it be a subsidy with your marketplace plan, or whether it be the fact that you might get a bit of tax credit or benefit from taking care of an elderly person that's within your family. So just don't miss those particular pieces.
Yeah. And as always, feel free, clients, if you have questions about any of these credits or deductions, or you want to discuss them or how they affect your family, we would love to have that conversation with you. As always, we feel it's really important to work with CPAs when you are working through these credits and deductions. So don't take anything that we've said and say, hey, Austin and Spencer said I can adopt a child and get tax credit. Make sure that you're walking this through with a CPA, with someone that knows your specific situation. And always leave comments down below, and we'll see you again next time. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.